Good afternoon again. It is my distinct honor to introduce Dr. Mark Calabria. Mark was nominated by President Trump in January 2019, confirmed by the U.S. Senate, and sworn in as Director of FHFA in April 2019. From our perspective at Ginnie, we're thrilled to have Mark's leadership at FHFA, and we look forward to future collaboration between our two agencies. Prior to joining FHFA, Mark was Chief Economist for Vice President Mike Pence, handling all economic policy issues with a focus on taxes, trade, manufacturing, financial services, and labor and housing. Immediately prior to his service with the Vice President, he spent 8 years as Director of Financial Regulation Studies at the Cato Institute. Mark also served as a senior aide to the U.S. Senate Committee on Banking, Housing, and Urban Affairs, and we're always very proud to call him a HUD alumni. Please join me in welcoming Mark to the stage.
Thank you, Marion, for that very kind introduction. And more importantly, Marion, let me thank you for your leadership and vision at Ginnie Mae. Let me thank all of you. Let me welcome those of you who've come from outside Washington. It's actually fairly decent weather for this time of year, but still nice to be inside at the moment. Let me also say how flattered I am. I know Dr. Carson spoke to you earlier this morning, and really just to be part of this lineup is quite an honor and quite flattering for me. I'm especially grateful to be here because I suspect that while most of the conversation today has been about Ginnie, there are these other entities that are in the mortgage market you may have heard about other than Ginnie. Fannie, Freddie, I don't know if those names are familiar to anybody. Also the federal home loan banks, important parts of the mortgage market, and important part of the work that I do at the Federal Housing Finance Agency. So a couple of things I want to do today, but foremost about that is talk to you about my vision for reforming Fannie and Freddie and where I see us going. But I thought before that, I think it's important to have a reminder of why. And I think it's important to look at some of the changes that have happened over the last decade in the mortgage market that really explain, I think, some of the concerns there, plus some of the opportunities and some of the benefits. I know that Dr. Carson touched upon this. I know Marion has touched upon this. But it really is fascinating to me and so important, the change that we've seen, the growth of non-bank, non-depositories as originators and servicers in the mortgage market. To give you some context, only as recently as 2013, non-banks made up 30% of all mortgages sold to one of the government guarantee programs. By February, that footprint had doubled to 60%. Last year, non-banks made up roughly 50% of all mortgage originations sold to Fannie and Freddie, and non-banks are now Ginnie Mae's main counterparties. They service around 60% of mortgages in Ginnie Mae pools, as you know. Some of you in the audience work in the non-bank sector, and you know how important that sector is and the role it plays in the mortgage market. It's important to have looked at this in the crisis, in the early days of the crisis when many commercial banks, depositories had to pull back. Non-banks stepped into that gap and I think in many ways provided important capacity to keep the market going in terms of both originating and servicing mortgages and of course providing liquidity. And we would expect, I certainly expect, banks, depositories, and non-banks to all play very important roles going forward, both in terms of origination and from servicing. But it does raise some questions, both I know for Ginnie Mae and as well as for FHFA, in terms of some of the key differences between non-banks and non-banks, banks and non-banks that need to be looked at and made sure managed in an appropriate way. So I would put it this way, making sure that we have prudent, sustainable risk management at FHFA, at Fannie and Freddie, among our non-bank, as well as our bank counterparties, is an important focus and something we will be looking at as we move ahead to make sure that originators, whether they're bank or non-bank, have that financial strength to perform in a stressed environment. I really want to commend the work that Marion has done in this area. I know there's a number of interviews and questioning and surveys that her team has done. Their recent progress update that they released this month really contains important overviews of efforts that Ginnie Mae has made to modernize its counterparty risk management practices. And I know as a taxpayer that allows me to sleep slightly more soundly at night, given the risk profile, not just of Ginnie, but Fannie and Freddie. And along those lines, I think there's a lot that Ginnie and Fannie and Freddie can all learn from working together. And one of my objectives in my role is to work with my colleagues across the street at FHA and work with my colleagues only a few blocks away at Ginnie to see what we can do to coordinate. As you know, while the Ginnie footprint now stands at over $2 trillion, Fannie and Freddie are over $5 trillion. Given that that's about $7 trillion of a $10 trillion mortgage market, between Fannie, Freddie, and Ginnie, that really is such an outsized part of the mortgage market. And I know we all share a common desire to see that housing finance system will perform well and remain strong throughout the cycle. I also want to note one of the things that has enabled the spread of growth of non-banks has been this rapid advances in technology and data analytics. In many ways, it has leveled the playing field, and I think has learned us a lot since the crisis to make sure that decision-making can be better analytical. And one of my objectives is to figure out how can I learn from what Ginnie has done, and of course, how can Ginnie learn from what we've done at FHFA to try to compare notes, if you will, try to exchange best practices as we try to move to figuring out what areas of the mortgage market require more coordination and make sure that we can adapt to those changes where the best practices that have been learned over the last decade. But I want to turn back to that question in terms of mortgage finance reform. While tremendous efforts have been made and tremendous progress has been made since the crisis, both in terms of servicing, in terms of the role of non-depositories, my view is that there's a lot that's not been done. I would argue that the fundamental structure of our mortgage finance system is basically the same as it was in the crisis. Yes, there have been a number of innovations, some of which I'll talk about, but I think the fundamental balance sheet, the fundamental role of the federal government, in fact, the role of the federal government in terms of risk bearer in the mortgage market is bigger today than it was before the crisis. So how do I make sure as we manage that risk, that we move forward, that we're in a better shape? And of course, I think we should acknowledge the progress that's been made. Fannie and Freddie's books of business today are so much better than they were in 2007, 2008. I hope to maintain that quality, if not improve upon it. But it's also fair to say that Fannie, Freddie are so much bigger part of the market. They're clearly too big to fail. I think as a financial regulator, it's hard to imagine any financial regulator that would look at the two largest institutions it regulates and see a leverage ratio of approximately 1,000 to 1 and be comfortable with that. So for me as a financial regulator, I want to make sure that Fannie and Freddie are ready to be there throughout the cycle and make sure that they can withstand any changes, whether it's house prices, interest rates, any macroeconomic conditions. The way I view this is that while I hope for the best, I do believe that every financial regulator has to plan for the worst. And so again, how do I make sure that the taxpayer, that the system is protected from any of those basic inefficiencies? I'll also note that one of the duties in statute that I have to fulfill as director of FHFA is to try to help create an efficient, competitive mortgage market. That is one of the first tasks that I am given as duty under statute. And I think in many ways, at least in the secondary part of our mortgage system, lacks competition. Fannie and Freddie are often a duopoly in many ways. I believe that actually hinders innovation, actually ends up in hindering price competition and many other aspects of our system that I believe leave the system more fragile and more vulnerable. So I think that to emphasize the broad parameters of our mortgage finance system are the same system we had in 2008. Is a reminder that system did not withstand well a 26% drop in house prices, of course an 80% spike in foreclosures, and trillions of dollars in evaporation in household balance sheets. I do want to emphasize, particularly as it sounds like I'm a little focused on numbers and the taxpayer, that a number of families, of course, were disrupted in this. I spent my time in the crisis working in the Senate on the Banking Committee, and while, of course, much of my efforts there were focused on helping create FHFA, the organization I run today, I also spent a lot of time answering the phone call from families in distress that were nearing foreclosure or at risk of losing their homes. And so I always continue to carry those stories with me and remember that, of course, when mortgage finance goes well, we open homeownership, we create opportunity, we build wealth. But when it goes poorly, there are real families at risk that go through tremendous amount of hardship. And I take it as one of my responsibilities to do my best to see that we never see a repeat of that situation. So again, I take away from that we need to change the overall status quo, despite the fact that the status quo in mortgage finance, of course, is at this moment quite comfortable. But I think it's a status quo that is fundamentally at the foundations unstable, unfair, and hence to me unacceptable. Under the status quo, I believe homeowners, I believe the taxpayer are all vulnerable to another shock to the system. So I do want to emphasize, I've said this in other contexts, I'll repeat it today. My view is we must move forward with a change in the status quo so that we can have a much more stable mortgage finance system. We've seen a number of reform efforts over the last 10 years. Many of these dealt with a number of fragilities in our financial markets, such as derivatives or too big to fail banks. But I think it's fair to say that despite changes coming out of Dodd-Frank, such as the qualified mortgage rule, that fundamentally the flaws in our mortgage finance system were not fixed with Dodd-Frank, and were not fixed with other elements during reform efforts of the crisis. So I do see that often this is the big piece that was left unaddressed in financial reform, and it's what I'm focused upon. Let me emphasize that I think this reform will take a number of avenues. There will be administrative action by FHFA. I will call on congressional action, but I want to emphasize that in my view, we need both Congress to act and we need FHFA to act. It's not an either-or, it's working in concert. I will note there are some things that only Congress can do. So for instance, I think despite some of the questions about the status of Fannie and Freddie, ultimately only Congress can come in and create an explicit guarantee beyond their debt. I lack those authorities. I am of the belief and will continue to encourage Congress to make sure that if an explicit guarantee is created, it is defined, we know where the lines are, that it is limited, and that it's on budget and paid for. So I hope that we can put the days of implicit guarantees behind us. At the same time, I will pursue administrative actions when they are appropriate and necessary to fulfill the mandates placed upon me by the statutes. I believe there are a number of opportunities we have working with Treasury, working with HUD, and working with my fellow financial regulators to try to build a more safe and sound financial system. And again, trying to make sure that we maintain homeownership in a manner that is sustainable so that when we get families in homes, they stay in homes. And I will take these actions working in close alignment with Congress and to make sure that we have that resiliency throughout the cycle. Just yesterday, I can understand perhaps if it wasn't the first thing that you picked up in the morning, but we sent our annual report to Congress yesterday, hot off the presses. Included in that report was a number of legislative suggestions that I made to Congress. I believe these reforms that I suggested this week would help better align the authorities of FHFA with those that other regulators have within our current existing framework. For instance, I've asked Congress to give me the authority to issue additional GSE charters. I believe this would allow more competition to enter the industry. And again, I fundamentally believe that it is competition that drives innovation, that drives consumer protection, and it benefits us in a way that can allow different business models to proceed. And so again, I've asked Congress for those authorities. Other regulators have those authorities. I believe I should too. And again, trying to make sure that we do increase stability by addressing the issue of too big to fail. So that's one. I will note that Banking Committee and the Senate Chairman Crapo has put forth a framework that is fairly consistent with the reforms that I have suggested this week. I will continue to work with Congress to see if we can have those legislative reforms agreed upon. I am hopeful because I believe that my visits in the Hill suggest to me that there's a bipartisan interest in a number of issues, that there's bipartisan interest in reform. I believe that there's a consensus in Congress that the system is broken. I'll be the first to say that perhaps there's not a strong consensus on where we should go, but I do believe there's a consensus on that there's an issue that we need to address and that we can get there. Let me also say, the last major housing reform that was passed was the Housing and Economic Recovery Act of 2008. I had the pleasure of being on the Banking Committee when we passed that. I will note that that bill passed the Senate with 82 votes. So I was there. I know we can do bipartisan reform that addresses a number of issues despite the current political environment. So again, I think if we can build momentum, if I can build momentum, we could get Congress to focus on this. But I really do want to emphasize, I think there are a number of parties who would say that, what's the hurry? Why do we do reform now? And again, my belief is the best time to reform the system is before a crisis, not during a crisis. And to paraphrase President John Kennedy, the time to repair the roof is not in the middle of a downpour, but when the sun is shining. I think it's fair to say right now, in terms of our economy, in terms of our housing market, the sun is shining. So this is the time to really strengthen the system because we have the ability and the flexibility to do that. I'm also someone who does, however, believe that the property markets have historically been cyclical. I believe that booms are eventually at some point followed by busts. Believe me, I hope that one doesn't occur on my watch, but I believe I have to plan for that and make sure that our system is in the right place that puts us on a strong foundation. And again, one of my objectives in reform, looking at Fannie and Freddie, is how do we make our system more counter-cyclical so that it's not necessarily, if you will, adding heat to the fire as the market is hot, but pulling back when the market weakens. But how do I make sure that Fannie, Freddie, and the Federal Home Loan Banks are there to put a floor under the market when the system becomes stressed? And again, trying to create a system that is more stable, more reliable, more liquid, to me, requires for us to do that in the long term, that system is counter-cyclical. I think it's fair to say that, in my view, that the housing finance system we have today, I think, is extremely pro-cyclical and will require a number of changes to where we can have that system become a moderating force on the macroeconomy rather than an accelerating force. Working again with my partners in government, I think as many of you are aware, in March, the President directed Treasury and HUD to develop a housing reform plan. We at FHFA have been consulting with both HUD and Treasury. My hope is to see this reform plan out soon. In fact, I hope it's out by the end of the month. But I think that will give us a platform upon which to build reform. I believe that we can create a system where taxpayers have confidence that the mortgage giants will never need another bailout. I think we can also build a system where investors will have confidence that America's secondary market is strong and resilient. Part of that strategy and part of my responsibility under statute is to try to create a path for Fannie and Freddie to eventually get themselves out of conservatorship. And so we will work toward a new reform structure of our mortgage finance system that protects the American taxpayer, that meets the housing needs of all families, and supports financial stability both at home and abroad. Let me say, as somebody who worked legislatively drafting the conservatorship language, that if you had asked me in 2008, I would have said I never expected any conservatorship to ever last more than 6 months. So the fact that we are approaching 11 years is quite frankly unprecedented. By comparison, the longest bank conservatorship was 18 months. So we've set some records, not necessarily in a way that I think we want to repeat. And again, I want to emphasize that having worked on the statute, the framework of the statute, that what has been followed is at odds with the statute. I believe that the law requires me to do what I can within my powers and authorities to fix Fannie and Freddie. Foremost, the most important path out of conservatorship for Fannie and Freddie is building capital. Capital, in my view, whether it's Fannie and Freddie or whether it's a large bank or whether it's a large insurer or any other financial company, capital is the foundation of safety and soundness. My primary concern today is that the capital levels of Fannie and Freddie are not commensurate with the risk they take. Over time, I believe they should ultimately operate under the same capital rules as other large financial institutions. One important step that I hope to make in concert with Treasury to help build capital is an end to the net worth sweep. I think it is worth recognizing, however, that ending the net worth sweep would allow them to retain capital, retain earnings, and build capital. But I think it's also fair to say that were Fannie and Freddie to try to build up capital through retained earnings alone, they would be in conservatorship for a very long time before they'd be able to exit. So with that said, we are looking at additional avenues for them to be able to maintain capital, whether it's a public offering, whether it's a private offering. I don't know if anybody in the audience has $100 or so billion sitting around, but I think there's going to be a need for this in Fannie and Freddie to try to build capital to help them get out of conservatorship at some point. I really do want to emphasize, however, none of this is calendar dependent. This is all process dependent. I intend to work with Treasury the remainder of this year to set up mile markers where the GSEs can meet those mile markers and be able to chart their own path out of conservatorship. But again, this is not by a certain date. This is going to be driven by how much capital we're building, how many issues are we dealing with, have we dealt with supervisory issues, and of course, as well, making sure to me that FHFA is ready for entities that are exiting conservatorship. So again, why I raise this issue, this is a long time in the making. But I also would argue that, to me, we need to make sure that as long as we have entities that are extremely highly leveraged, that's one side of the balance sheet. The other side of the balance sheet is asset quality. And as long as there are entities that are essentially leveraged 1,000 to 1, the asset quality has to become much more targeted in terms of sound risk management and making sure that the type of loans that are being made do not put Fannie and Freddie at jeopardy. So we'll be pursuing regulatory reforms at FHFA that I believe will put us on the transition to getting Fannie and Freddie out of conservatorship. We'll be making changes that I believe will prepare FHFA for an exit out of conservatorship. But I also would note that while I've emphasized capital, there are a number of other changes. So in order for Fannie and Freddie to leave conservatorship, they must be, in my opinion, first in class in corporate governance and risk management. They must deal with a number of supervisory issues, that they are a safe and sound company with a clean bill of health. Along those lines, we'll be reviewing directions, rules, regulations, programs that were begun previously. We'll be reviewing these rules to make sure they are consistent with a safe and sound Fannie and Freddie. We'll be reviewing these rules to figure out what we've done in conservatorship should move over and stay in supervision. And if there are instances where rules and pilots and programs and other activities that we're engaged in are not consistent with an exit of conservatorship, we will be ending those. And again, making sure that the activities are consistent with trying to build a safe and strong Fannie and Freddie. One area that has gotten attention over time is the extent to which Fannie and Freddie have pushed the envelope on activities that may or may not be within their charters. I take a very strict view as someone who's a former legislative staffer. My view, of course, is if it's not in the charter, it's not allowable. And I will not indulge creative readings of the charter. If it's not enumerated, it's not clearly there, then it's not in the charter, they won't be doing it. So again, part of this will be a review of the activities, making sure existing activities are in the charter. Again, as I mentioned earlier, one of my statutory mandates is to help create a competitive mortgage market. Along those ends, I believe I must work with other financial regulators as well as myself to make sure that Fannie and Freddie face a level playing field with other players. At the end of the day, to me, this means that Fannie and Freddie should be successful because they have best execution, best management, best business practices, not because they have weaker rules than everybody else. And again, trying to make sure that everybody plays by the same set of rules is an important part of creating, in my opinion, a competitive, resilient mortgage market. I recognize that this is an ambitious agenda and a turn in direction for what I think Washington has pursued in mortgage finance policy in the past, but I am optimistic that we can make considerable progress on this front, and I look forward to seeing us make progress on that front, and I look forward to us charting a path of a much safer and sounder mortgage market. So with that, I thank you for your time today. Again, want to congratulate Maren on the great work she's done and the great event conference she's put here today. And again, look forward to charting a new path. Thank you.